Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs Fundamentals Analyzer software tool and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This particular video is going to take a look at three iconic names that have taken on an enormous amount of debt lately, and I'm looking at the time frame just coming out of the Great Recession as I'll be looking at these three companies. But the key is, there's a lot of talk about how much debt corporate America has taken on. According to Standard & Poor's, it's well over $10 trillion now. Credit ratings have been collapsing and falling dramatically. Here's McDonald's, an iconic name, one of the leading, highest quality blue chip stocks in the country that only commands a credit rating of BBB+ today. That is investment grade, but it's certainly not even A grade. But I want you to notice the company has 117% debt to capital. And as I'll show a little bit later, they actually have negative book value or negative common equity right now. If I look at it fundamentally, I'm looking at adjusted operating earnings here. The earnings of the company have done well since coming out of the Great Recession. The stock price has done extremely well. Let's take a quick look at performance and compare a $10,000 investment in McDonald's since December 31st, 2008, just as the recession was ending, to yesterday's close, and we see that McDonald's outperformed the S&P 500 on a total dividends basis, came pretty close to equaling the performance of the S&P on a capital gain basis, and just slightly underperformed the S&P. And by the way, this is really good performance over this time frame for the S&P. So the point is that the company has taken on all this debt, and I'll get into that in more detail in a moment, but yet it has still performed well. But I really want to look at it from a standpoint of cash flow, because I'm not so much interested in earnings. There's a lot of accounting convention, but let's look at operating cash flow. Now, operating cash flow is also a metric that takes into consideration a lot of accounting adjustments. Simply stated, operating cash flow is net income plus non-cash expenses plus changes in working capital. So there are some adjustments in operating cash flow, but essentially it's the money that the company has available to pay off its debt obligations, and also for dividend growth stocks, as all three of these stocks I'm covering are, it also shows whether the dividend is being well covered or not. So I also want to look at this company from a standpoint of EBITDA, or earnings before interest, taxes, depreciation, and amortization, because it's a little more pure cash flow, if you will, because it doesn't include some of these accounting adjustments that I mentioned in operating cash flow. So when I look at operating cash flow in McDonald's relative to its, covering its dividend, you can see the dividend is very, very well covered. So from the standpoint of producing cash and covering their dividend, at least, McDonald's looks very, very attractive. And of course, its performance has been quite solid. Let me move over now to FundGraphs, which is our acronym for financial underlying numbers, and look at McDonald's from a balance sheet analysis point of view. And what I'm looking at here is their common equity or book value. And what I want you to see very clearly here, and I covered this in the written portion, is the company's common equity has fallen dramatically from $14.03 billion to a negative $821 million at the end of December 2019. McDonald's has had negative shareholders' equity or book value since 2016. Now, I want to look at that from a comparison of debt, because, as I pointed out, they have over 100% current debt to capital right now, and you can see that their debt has grown substantially, and as the debt has grown, the book value has obviously shrunk. So the company now has gone into a very high level of debt, more than equity, producing significant amount of negative equity, but yet the company's performance has still been quite good, as I illustrated a moment ago. I also want to take a look at common shares outstanding, because, that's been part of the issue. They've been raising this debt, and they went from 1.1 billion shares in December of 2009 to 765 shares. So they've taken on all this debt. They've completely destroyed their book value, if you will, or wiped it out, maybe is a better way of saying it, and yet they've been buying back shares at a rate of about 3.6% compound annual growth rate annually. So they've reduced shares dramatically during this time frame. Yet with all of that, McDonald's still looks like a healthy enterprise from a standpoint of its ability to produce and to cover its debt and even eventually reduce its debt. The key is companies are borrowing this money almost free today, and that's why they're doing it. So, it is having its effect, but as I covered in the written portion of the article, these companies have resources on their balance sheet that aren't necessarily being properly given credit to, especially their brand, and that's something I'll talk about in part 2. Now next, let's run through a similar analysis with the second iconic brand I'm covering here, Home Depot. Now, in the case of Home Depot, they are A-rated. They still have an A-rated credit rating from Standard & Poor's. The company has 95% debt, where McDonald's had like 117% debt. But if I look at performance since coming out of the Great Recession compared to the general market, you can see that Home Depot has dramatically outperformed the overall market since January 31st, 2008. And this company has a different fiscal year, so we're looking at a slightly different time frame. But you can see they generated more than twice as much dividend income, and they, more than 3 times as much capital appreciation. Their total return was just under 20% a year over this time frame, compared to about 8% for the market. Remember, this is a different time frame than I showed you with McDonald's. So the company's done extremely well. Once again, the company does have a high amount of debt, and I'll get into that in more detail in a moment. So let's look at operating cash flow. Once again, we see operating cash flow covering the dividend. And then we also see, when I take a look at, without the accounting adjustments that are in operating cash flow, by looking at EBITDA, which is before depreciation and amortization, interest and taxes, EBITDA growth here is very strong. Again, Home Depot has ample cash to cover its obligation. Now, moving on to the balance sheet, by going back to financial underlying numbers or fund graphs, we once again start by looking at the company's book value or common equity. And this is in millions here, not per share. And you can see their book value went from 17.7 billion, almost 17.8 billion, down to a negative 311 million. And book value has now been negative. This is the second year in a row that Home Depot's book value has gone negative. Now let's look at it from a standpoint of total debt. Let's add total debt to the equation like we did. And once again, you see this huge growth in debt simultaneously to this destruction of book value for the company. And then when you see, what's happened with the company from a standpoint of common shares outstanding, let's go ahead and look at common shares outstanding as we did with McDonald's. And you can see that Home Depot went from 1.69 billion shares to 1.1 billion shares. They've been reducing their share count by 3.8%. Now, in some ways, this helps shareholders, as I talked about in the written portion, because, on a per share basis, the company is able to report better earnings and even a higher rate of dividends because the individual shareholders are getting a higher percentage ownership in the company. Nevertheless, it has destroyed book value, but the company looks healthy, as I just pointed out a minute ago, enough to be able to continue to amortize this debt. And then for my final analysis, looking at this debt analysis of these 3 iconic brands, let's take a look at Starbucks. It has an interesting story all in its own right. Although each of these companies have very similar characteristics going on, there are some real differences here with Starbucks that I would like to point out. First of all, I want you to notice the company has a BBB+ rating. Again, that's investment grade, just shy of A-rated. The company has 125% long-term debt to capital. As I'll show in a minute, again, they've taken on all this debt while the stock price has continued to rise. In fact, it continues to trade at a very high premium valuation, too high in my view. Now, this company has been affected by the COVID crisis more than we saw actually even with McDonald's and certainly with Home Depot. Obviously, they have the restaurant side of their business, and the walk-in, sit-down part of Starbucks is a very important part of their business. But when I take a look at it from a standpoint of operating cash flows, once again, looking at how well are they covering the dividend, it's a little bit different picture here. They haven't been as consistent as we saw with either McDonald's or Home Depot, and this is kind of troubling, but yet the company has performed extremely well. When I look at the long-term performance here, going back to the time frame of just coming out of the Great Recession that we've been covering here, you can see that Starbucks has dramatically outperformed the S&P 500, dramatically produced more dividend income, even though it hasn't been paying in dividends for that long, significantly outperforming it on a capital appreciation basis, 22% versus 8.4. And again, these are slightly different time frames in each of these that we're measuring here, but they've dramatically outperformed the market, as you can see. But yet their cash flow has been spotty and hasn't always even covered the dividend over this time frame. But again, they only started paying a dividend since 2010. Now, when I look at EBITDA, where I have less accounting convention, including in the data here, when I look at EBITDA, the company's performed much better on EBITDA, and EBITDA shows that they are covering their dividend rather well. So from that point of view, the company looks fine on a price to EBITDA basis, even on valuation. But again, it's taken on all this debt. So let's go ahead and look at fund graphs. The first thing that strikes me about Starbucks relative to the other two companies we looked at is the company was actually growing book value through 2017. Well, it shrunk a little bit from 2016. It shrunk a little bit from 2012 to 2013, but they've generally been increasing their book value. But I want you to notice they went negative equity in 2018, and they're significantly negative equity-wise in 2018. It didn't go negative equity in 2018. It had very moderate book value, 1.17 billion, until it finally went negative book value or negative common equity. But what's interesting about this, there's some differences here. When I look at total debt, we see that the company has taken on substantial debt. I mean, we've had these huge increases here in total debt over the last 2 or 3 years. And of course, book value has finally gone negative. But something that also I think is very important. Before I do that, let me go ahead and look at common shares outstanding now, because it's a little different than the other companies. They have not been buying back shares as aggressively as McDonald's and Home Depot has. But if you go to the written portion of the article and look at the table that my son Colton produced, I want you to notice that the company has virtually retired all of its treasury stock, and they really don't have the dry powder of these other two companies. That's something very interesting. You can find the written portion of these articles either on the FastGraphs website or on Seeking Alpha's website. But regardless, there's quite a bit of difference here between Starbucks, Home Depot, and McDonald's, yet all three of them carry substantial amounts of debt, and yet they've all performed admirably, and two of the three, Home Depot and Starbucks, have dramatically outperformed in spite of the fact that they have all of this debt. Anyway, in closing, like I'm sure many of you, if not all of you, have basically always looked for companies that had low debt, as I have most of my 50 years of doing this. You know, there is a reason why these companies are taking on all this debt and why they're behaving like they are. And of course, the answer here, this is looking at the 10-year Treasury yield. The answer is strictly what's been going on with interest rates since the 1980s when they got exceptionally high. Remember, rates were back up here. The 10-year Treasury was over 15% back in the early 80s. And now, you know, as of April of this year, the yield on the 10-year Treasury was 0.66%. So what this is a benchmark for interest rates. And what's been going on here is these companies have literally been able to get what I think they think of and what I probably think of as free money. They've been incentivized to take on all this debt because they can reinvest this debt at significantly higher returns on invested capital than they have to pay for it. Now, how this is all going to end is yet to be seen, but the reality of it is it's not as crazy as it looks, perhaps, simply because the cost of debt has gotten so low here in recent years. So again, I'll end with something that's in the written portion of this article that you can see. If you look at these three companies, Home Depot is earning 40.5% return on invested capital, and the after-tax cost of their debt is only 1.7%. Their weighted average cost of capital is 7%. Obviously, equity is much more expensive for them than debt. Looking at McDonald's, they're returning 19% return on invested capital. Their net after-tax cost of debt, remember, with a slightly lower credit rating, is 2.16%, and their weighted average cost of capital is 5.1%. And then finally, Starbucks is actually earning 47% return on invested capital. It's costing them 2.5% to borrow the money, and their weighted average cost of capital is only 6.2%. So at the end of the day, as long as you see numbers like that, I think the appetite for corporate America to use debt to capitalize their businesses is going to stay strong. It's something we're going to have to think about and live with and adjust to. And, you know, it's getting more and more difficult to find anything that has very little or certainly no debt on their balance sheet. But the question is, you need to answer for yourselves, as I'm struggling with, is debt all that bad? It seems like these companies can handle it currently, but again, time will tell. Thanks for watching. If you liked what you saw here, I appreciate it. You might want to take a look at our Dividend Kings website for long-term investment ideas. Thanks for watching. This is Chuck Carnevale.